Leora Partners. The partners are going to be talking about best-in-class strategies for 2016 private equity fundraising, venture capital fundraising, and also corporate fundraising. Leora is a boutique placement agent and advisory firm that raises capital for alternative asset companies and other growing companies. Since 1996, they have helped firms raise money for a wide variety of strategies, and for many years, Navatar has been helping them behind the scenes. Navatar is a connected growth platform for the financial industry that runs on Salesforce. I'm Alan Siegert of Navatar, and it's my pleasure to introduce today's panelists. On the left, we see Jackie Beckwith, who's been with Leora Partners more than 20 years. She has private equity and venture capital experience in the U.S. and Asia, including capital raising. Next to her is Peggy Caldwell, who has more than a quarter century of experience with a wide variety of institutional clients and long-only investments. And we have Leora founder Jane Morris, with 30 years of private equity experience, including 20 years as a placement agent. As I said before, it's been our pleasure as Navatar to be the technology that Jackie, Peggy, and Jane have used so effectively to accelerate their fundraising. In fact, Leora is one of more than 600 financial firms using Navatar services in more than 30 countries. Now I'm going to turn it over to Jane, who's going to kick this off for us. Jane?
Thank you, Alan, and thank you to Navatar for sponsoring this event. Good morning or good afternoon to all our participants. Thank you for joining us. We are going to present our thoughts regarding fundraising for about 30 minutes and then look forward to answering any questions you may have. Most of our comments will relate to illiquid strategies, but we are going to comment briefly on some issues specific to hedge funds as well. First and foremost, fundraising is a full-time job, not a short-term activity. You are either actively seeking new investors, pitch book in hand, or you are laying the groundwork for your next fundraise. Building your portfolio and generating returns is the most important focus for any fund, as we know, but what is equally important is building your firm. So in between fundraisings, what are you doing? Well, you're building your brand, you're seeking ways to enhance your reputation as a firm and heighten your visibility as well. One of the main things you need to do is maintain your focus. You have to do what you said you were going to do. Don't stray from the strategy that you told investors. Very often, a fund will see an opportunistic investment and it looks attractive, but they rarely work out. And when they don't, you not only lose money, but you lose your credibility with your investors. The main thing that you need to do in between fundraisings is to strengthen your relationship with your existing limited partners. And this is done through continuous communication, very open, very honest communication, transparency, so that you can build trust with them. A well-organized, well-managed firm won't compensate entirely for poor performance, but it will help you if the portfolio hasn't yet fully matured or if the performance to date is merely acceptable. Performance is very important, but it isn't the only factor investors consider. As an aside, if you are unsure how well you are succeeding in your fund management, or if you want to get your firm to the next level in its development, please give us a call. We are a placement agent, but we have also helped many firms gain access to the perceptions of their investors, their CEOs, their co-investors, and other constituents that are important to them through confidential due diligence analysis on the firm that we can conduct. This information, knowledge, can make a big difference in how you build your firm and the positive changes that you can make between fundraisings. Short term, the mantra for fundraising is really plan, prepare, present. On the plan side, when do you go out? Who in your firm is going to lead the fundraising? How are you going to do it? Are you going to use an agent? Are you not going to use an agent? Once the right timing for a fund is a little bit of a balancing act. It should start when you have some performance, and that would be 2, maybe 3 exits at a minimum, and not when you're about to run out of money. when you're preparing, once you determine the timing actually, and again, it should be when you have some performance, you begin the process about 6 months before that date. The first order of business is to hire a placement agent if that's what you're going to do, and we're going to talk about that a bit later, and work with them to prepare professional marketing materials and plan your fundraising strategy. It will take a couple of months, if not longer, to identify the right agent, and then leave at least 2 to 3 months, 3's better, to prepare the PPM, the pitch book, the DDQ, performance analysis, write-ups on all your portfolio companies, and any other collateral materials that you may need. We highly recommend setting up a data room where all these materials can be accessed by potential investors. Data rooms are efficient, and they give you insight into who is viewing your materials and how often. You can easily update the information or add to it when is necessary. Navatar has actually developed a virtual data room that integrates with their fundraising software, which we've been using for many years, as Alan mentioned. This virtual data room can be used also independent of their software, and I'm sure you can set up a demonstration with Alan to see the capabilities of that. The final piece is the presentation. We could have an entire webinar just on the presentation aspect of fundraising, but I'm just going to briefly go over a few items on that. It's your spoken narrative. You want to include lessons that you've learned. You want to make sure that you know your audience before you go in. Ask them questions. Triangulate on their concerns. Show camaraderie and relationship with your team and with the audience. Watch their body language. You want to highlight the specific qualifications you have to carry out your strategy. You want to include case studies, and you want to include your vision for the firm. I mean, as I said, this is just really scratching the surface on the presentation, but did want to give you a little bit of color there. Fundraising is obviously not one size fits all. Firms are in different stages of their development, and since our audience today is mixed as well, we're going to discuss first-time and mature funds and all the funds in between to see what specific strategies they may need to be successful and the role of a placement agent should they choose to use one. To begin that discussion, I'm going to pass it to Jackie, who's going to offer some strategies for first-time, spin-out, less mature, and mature funds. Jackie?
Thank you, Jane. Yep, thank you, Jane. I'm Jackie Beckwith, one of the directors of Leora Partners, and I work on the sales side. I will now focus on the fundraising process for primarily the private equity space, which includes venture capital, real assets, private debt, and buyout funds, amongst other illiquid strategies. And later on in the presentation, my colleague Peggy Caldwell will address the more liquid markets. For first-time funds with no track record, the primary source of capital will be family, friends, and potentially other business contacts whom you may have worked with. It's best to keep the fund size small, raise what you can, prove your strategy and fund management ability, and then you can expand in Fund 2. We're assuming here that you have a track record in a certain sector and experience, be it operational or financial. You may have done a few club deals and are now ready to raise a dedicated fund. These club deals can act as your track record. Areas of focus will be on differentiation and positioning. What makes you special? It could be a niche in a large industry, a particular expertise, ability to source unusual deals, successful exits in previous deals you've led. Here, excellent references will be very important for you. The fund strategy has to resonate with your background. Investors will not give you credit for venture deals when you're out trying to raise money for growth equity transactions. And we recently worked on a spin-out fund where the principals had decades of experience in the venture space, but in their new fund, they were moving more into the growth equity stage. And despite having all this experience working together and in the venture space, and even a portfolio that was over 70% invested, many investors pointed out that this was a quote-unquote new area for the team and they took a pass. So they can be pretty unforgiving in this area. The role of a placement agent in first-time funds is primarily in helping to put together your materials, i.e. the presentation, the executive summary, and the database, and helping you to clarify your message to investors. They can also help you with your oral pitch and presentation. Placement agents don't normally assist funds in this category, but there are exceptions, so it doesn't hurt to make a few calls and try to find an agent who will help you. First-time funds often believe they can turn to the emerging manager program sponsored by institutional investors. While it would seem to make sense, these programs are not interested in first-time funds. They prefer second and even third funds. If you're located in a geography without a lot of capital, you may be able to attract some state fund or economic development money. Finally, I would add that investors prefer funds with at least 3 partners. Only 2 partners is difficult. What if they don't get along? And this does happen quite often. So now we're going to move on to spin-out funds, or funds started by individuals with a track record from prior funds with which they were involved. For spin-out funds, life is a bit easier. We're assuming here the team has worked together for some time and that there is a transferable track record that is investment grade. That is the ideal situation. Verification of the track record is going to be important. A placement agent can help with this process by digging down into the track record and differentiating which deals were sourced, worked, and exited by the team members. Lessons learned is also helpful, as Jane mentioned, to include, as well as clarifying who led the deal. Piggybacking off of other competitors is not as compelling as leading the successful deal. A placement agent can also help by calling the references. We have found that some references should never be references, and although they tell us what they tell us is confidential, we may suggest to the fund manager that they use someone else. Even though the team may have worked together for several years, they will still be viewed by investors as a first-time fund and team. The manager needs to find as many points of common interest that the team members have to demonstrate to investors that they share similar values and objectives. You may have spun out with a core team and added other specialized industry experts, for example, or you may have come from multiple funds. How long has the core team known or worked with a new member? Have they worked on previous transactions, shared a board seat, worked together at a previous firm? All of this needs to be communicated in the presentation. A major risk in investing in first-time funds is that the management team may not survive the first fund if they have not worked together before. Obviously, the longer you've known one another, the better. If you just came together to launch the fund, it will be difficult to convince investors that there is no risk. Often, how you interact with one another in meetings with investors can help. The placement agent can play an active role in sales for a spin-out fund, but the first close will likely be the responsibility of the manager. They will be reaching out again to family and friends and to investors from previous funds, if they are allowed, or investors from previous transactions. They need to demonstrate that they have investor support. After the first close, the placement agent is able to expand the database. Moving on into funds raising capital before the first fund has shown much progress. We see a number of funds who have raised a small amount of capital for a first-time fund, have invested over 75% of the capital, and want to come back to market to raise the second fund. They want to remain viable in the market, which means having capital to continually invest and source deals. To raise a second fund, they're going to have at least 2 to 3 exits and/or to have exited at least 30 to 40% of a fund. Fund 1 investors are going to need to support Fund 2 in a first close, and most investors will want to see some realizations before committing to a second fund. There are no exceptions to this rule. The key area of focus for second-time funds will be the performance book. Did they stick to their investment guidelines? Is the portfolio diversified? Have they committed too much to one investment? Have there been markdowns or markups in the portfolio? Have they led most of their deals? How have they added value to the investments? All of these questions will need to be addressed, and it is a great opportunity for the manager to demonstrate their excellence. A placement agent will be able to clarify the pitch and performance attributes that are going to be of importance to investors. After a first close of existing investors, or even before the first close, depending on the number of portfolio realizations, a placement agent can start reaching out to investors. Depending on the size of the second or subsequent fund, which hopefully would be ideally over 100 million, they can introduce new types of investors who can invest larger amounts of capital. So finally, we have mature funds. Even fund managers that have had 3 or more funds can utilize the services of a placement agent. Mature funds may have vintage years that were not as successful as other years and need help in recrafting their message. Since the downturn in 2008, money has shifted tremendously, and existing investors may no longer have the capital to invest. They may have merged, may be cutting back in the asset class. New investors have been created since then. Placement agents know best where to find the money, who is active, and who is looking for the exact product you are offering. They can help the fund manager top off a fundraise with high-quality investors. Today, there's a lot of noise in the market. Most investors are having 100-plus phone calls daily and emails, and placement agents have the relationships established over years, and investors rely on them for quality product. I now turn this over to Peggy Caldwell, who will go into more detail on the liquid strategies and the investor base. Peggy.
Thanks, Jackie. I'm Peggy Caldwell. I'm one of the 3 partners, and like Jackie, the 2 of us primarily focus on capital raising, both for companies and for the selected clients we take on in the private equity or hedge fund space. I don't think I need to tell any of you that hedge funds have had a lot of issues over the last couple of years. Higher beta exposure than what investors thought they were getting, and part of that is investor due diligence and the overlap of holdings between some of these different hedge funds. But I would say that all the points that Jane and Jackie made for the private equity or venture or credit funds relate directly to the hedge funds as well. But what we would say is minimum traction for investor interest would be at 100 million AUM, and I actually think that's low. Many of the investors that we speak to need to see 250 million or more, and a lot of that has to do with trying to mitigate organizational risk. The good news is that to have a strong back office and infrastructure isn't going to cost you $1 gazillion. There's a lot of really outstanding third-party organizations that can help with risk management and other back office functions. So you can present a very strong team to the investor base and not have to spend a lot of money on some of the back office pieces. One thing that we feel very strongly about, especially in the quantitative space, is back testing is heavily discounted by investors. I know that in many quantitative strategies, it makes a lot of sense, but people want to see actual performance with money invested coming in and out of the marketplace. As I mentioned when I started the conversation, beta exposure is really kind of a bad word right now. They're not going to pay for this kind of exposure, so non-correlated strategies are what a lot of investors are looking for and the most attractive to them. We continue, I think, on both the private equity side, depending upon the strategy, and in the hedge fund area, to see pressure on fees, especially for new funds. We would never, and we were having this conversation, Jackie and I were having this conversation with a new manager last week, we would never expect anybody to go out with a losing proposition in terms of money. You need to have runway money. You need to be able to show that you've got staying power during the capital raising process and during the the investment process. But to be able to more competitively position your fees is going to show people that you're interested in trying to work with them. Lockups in this space, you need a compelling reason. If you have a strategy that does require a 2 or 3 year commitment, maybe you're investing in a public-private kind of strategy where there's some illiquidity, it's easier to justify that, but you just need to make sure that people understand why you're doing it. To the last point, and I think this is true, and Jane and Jackie made this point, I think for any of these strategies in the private equity world or the more liquid world, you need to have a statistically significant set of data for people to look at. Especially in the credit strategies and the liquid strategies, people do a lot of regression analysis. They do a lot of quantitative analysis to see if your strategy will fit into their overall portfolio. Now we're going to spend a little bit of time on the different categories of investors and who might be the right people to approach. As Jackie mentioned, there's been a tremendous wealth transfer from the large wirehouses and the large brokerage firms to more independent registered investment advisors and wealth managers. They can be more approachable. In many cases, you want to determine whether they have discretion or they don't have discretion. If there isn't discretion, there's another level of sales to the client managers who actually have to go present the strategy to their underlying clients to see if they're interested. They can be more interested. I would say, except for the larger ones, they may not be, first-time fund kind of investors. The second category is an important category when you're probably in Fund 1, but for actual fundraising, Fund 2 or Fund 3. Many types of investors, endowments and foundations, some family offices, a lot of the local, state, and pension funds hire consultants to help with fiduciary risk. So for that reason, they have to kind of, prove their worth, and they do a lot of due diligence. They can be conservative. They take their time getting to know managers. However, once you get on their approved list, it's, you're selling to the consultant, but then the consultant may bring you a large number of clients. Family offices we found to be the most open to new strategies and firms. The larger family offices probably would be more appropriate. The smaller family offices generally tend to use consultants or look more at fund-to-funds types of strategies. Endowments and foundations, the larger ones, do not use consultants, or they may for certain specialized areas of investments. However, they need to be able to see statistically significant data. They're probably more interested and comfortable with a spin-out group from a group that they've invested with before. But they do look for niche types of investors, and managers, and are happy to start a dialogue and then follow a manager. But this is where we've seen the single biggest ask for statistically significant data sets. State pension funds, Jackie alluded to them earlier, do have emerging manager programs. Generally, these guys and gals need to write for traditional investments because of their size to make an impact on the portfolio, a $50 to $100 million check. They work with specific consultants who run their emerging manager program or their women and minority manager program. Those checks can be smaller in size from their perspective, 25 million, but you're going through the consultant, again, to get access. And then Jackie mentioned that in certain states, the local and the state pension funds want to attract industry. So there may be some niche sources of money, even for first-time funds within, certain states like New York and Ohio, places that want to attract additional new business into their state. Now we're going to talk a little bit about some of the pitfalls that come along with fundraising. And I think the single biggest thing that I would tell you is if you hire a placement agent or somebody else to give you advice on how and when and what to do, listen to them. You know, I think we love to tell people that, you know, you only get one chance to make a good first impression. So that if you go out with no performance from your first fund, you know, people sometimes get excited and will give managers what we call conceptual early money for a new kind of strategy, but then they want to kind of see delivering, you know, the returns before they give you more money, or other people are going to give money to an actual fund. If nobody in your organization is a good presenter and you don't get outside help, you may not get a lot of traction with investors. As Jackie has mentioned, all the people that we speak to get hundreds of phone calls, hundreds of emails almost every day. And if there isn't, they're looking for a reason to say no. No one wants to replace existing managers. So if the story is confusing or they can't understand it, they're just going to say no. You know, it kind of relates to the third point. You start before the stories refined and the materials are done. The story's not compelling, they're going to say no. You can go out with aggressive terms if you are a spin out, you've had a, you know, a great pedigree. We've seen it with some of the most successful hedge funds. But I think that's something that you have to kind of balance. If you've already got $1 billion in commitments in your spin out fund and people are fine with whatever your terms are, that's great. But I would say that that's probably not necessarily the norm. People look at who you hire as service providers. Get the best you can in the business that you can afford, because that's going to give investors an indication of the fact that you really want to be a world-class firm. We've had some pushback with some of the managers we've worked with in the private equity and credit space, where they've used accounting firms that no one even knows who they are. And, you know, valuation, as we all know, and that part of the marketplace is very important. And if people can't get comfortable with who you're using as an accountant or who you're using as a lawyer or your fund administration provider, they're going to be less inclined to move forward. You hire an agent and you don't listen to their advice. You know, it relates to all the points that are mentioned before that. And then another thing that we deal with all the time, and Jane mentioned this at the beginning, is if you have an unrealistic timeline. You have to understand that you want to spend the time to get ready, have your message positioned properly, and then it's going to take time to get traction with people in the marketplace within the right investor profiles that are being targeted. You know, as Jane said, it can take 18 to 24 months to do a fundraise, sometimes even longer. So you just have to be prepared to put in the money, the time, and the effort and hire the right people. And now, Alan, I'm going to turn it back over to you for any questions from the listeners.
Okay, and we have been getting questions during the webinar. If you want to ask a question, just enter it on the GoToWebinar panel on the right side of the screen, and we will get to you. Jane, here's the first question. Steve asks, how much money do limited partners expect GPs to invest personally in a fund? In other words, what are the rules around how much skin in the game?
Yeah, that can be a real issue for some fund managers, particularly where it's a first-time fund and maybe they haven't made a lot of money yet, and they're concerned that they're not going to be able to put in enough. I think investors, I mean, general rule is 2% of what the capital is raised. I mean, that's the general amount. But investors are also looking to see, you know, how much capital do you have? I mean, if you happen to be a wealthy individual and you're only putting in the minimum 2%, they're not going to believe that you have enough skin in the game. And the reason for that is they're afraid if things don't go well, you can just walk away. So it really relates directly to your own personal financial situation. They just want to know that it's painful for you if you walk away.
Brian in Australia wants to know if you have posted a Jobs Act 20 to 50 million offering, and he's got a follow-up question. Have you posted a capital raising from a private company from Australia? And what has been the largest alternative asset raising you have completed?
it's Jackie. We have not done anything on the posting yet on the Jobs Act, although I've seen some other groups come into that space and actually go through other different types of social media to do a fundraise and to contact investors. We have not done that. And Peggy maybe can speak to the compliance side on that because she handles that. And then the largest fundraise, we continually raise capital for some managers. So we usually do between 300 to 500 million. That's our sweet spot.
Sebastian asks, what do you think about sector-focused private equity funds, especially in the sustainability areas?
I'll take a stab at that. I think sector focus is really good. It's excellent. I think the more you can show expertise in a particular area, the more interested people are going to be, especially with a track record. I had the opportunity to be at a seminar 2 weeks ago where there were some very large family offices speaking. You know, ESG, sustainability is a really hot topic now, but what these family offices said is they're very interested in this area, but the return profiles need to be in line with the other investments that they're making. And one of the family offices told a story about a certain part of the world needing more water, which certainly is a big theme, as we all know. And they sent cases of bottled water to this country. It was in Central America. And the government just destroyed the water, and it never got where it needed to go. They took a different tact and actually developed a company that produces water in the Central American region, and they're doing really, really well from a profitability. It's meeting all of the guidelines that they need to meet for company investments and longer-term investments. So the big point is that there's a lot of interest, but altruism needs to be tempered by good returns as well. And I think that's why we're seeing so many large organizations in the world start moving into a sustainability mode just generally because they can save money or they can make money. You know, altruism is wonderful, but capitalism needs to go hand in hand with that.
Alex asks, what's the going rate for a placement agent fundraise? What should we be expecting?
Are you talking about fees?
Yes, I believe that's aimed at fees.
Sure.
Yeah, must be.
Okay, so for the most part, for let's say private equity, it's usually about 2% of the capital raised by the placement firm. Sometimes that can be a little higher depending on the size of the fund. If it's a small size fund, it could go up to 2.5%. So, and for the more liquid strategies, the market rate is usually about 20% of the management fee and carry. And sometimes people do. It really depends. There are some other ways that the placement agent can charge, which is to take part of the back end, the carry, if indeed the manager is going to require the management fee to really operate, and they're not going to be able to pay you out. So sometimes, there's a negotiation there, and the placement agent can be more invested in the actual fund.
Okay, Cindy has a question. You said at the beginning that you use Navatar in your fundraising work. I'm interested in knowing how it helps you. We're looking at it and whether it helps to have your clients using a similar service.
Yeah, the Navatar system is really built on Salesforce, but it is specifically designed for fundraising. And the reports that we're able to present for our clients and the information that we are able to input includes, all the emails that we send out, conversations, the calls. I mean, everything is recorded, and that's important for us, just to know that information ourselves. But it's also important from a legal perspective, a FINRA perspective, because we're obviously licensed broker-dealers. We have not worked with a fund that I'm aware of that also uses Navatar, although we certainly recommend it. I think when we're when we're working with a fund, the burden of fundraising is generally more on us. So they rely on us to do most of the calls and follow up, et cetera. But it's been a very, very robust system for us, and we're able to do some add-ons to it as well that have been very effective.
James asked, any specific...
One last thing, one extra thing. Jane was mentioning some of the add-ons. What's great is that there is some syncing capability with other databases, which makes our life so much easier because we don't have to re-enter. That's really important.
Can I just make one more point, too? We were talking to a manager who, it's a fund of funds, but I just want to make the point that they had Salesforce, and I think it was another Navatar program where they were really able to drill down to the company level and show all the contacts, why they liked the company, what they didn't like about it, but going back a really long time. And from a diligence perspective, if you have an investor looking at your process, it really helps to have an integrated system where you can sit with them and you can show them how you track, progress in terms of company investments or at a fund-to-fund level, fund investments.
Okay, speaking of fund of funds, James asks, any specific comments on fundraising for private fund-to-fund vehicles?
We get approached a lot in that area. It's not an area that we like to focus on as much. The fees tend to be, mostly because the fees tend to be lower, and so it's just as much work for us. The fees on a fund of funds usually are about half what is a normal private equity, and there's a lot of competition out there too. So it really depends on the type of fund of funds that you're working with, and whether they're going to be able to differentiate themselves from other fund of funds, because as we said, there's a lot of competition. The fees are not high, so then we don't get paid as much, and it requires at least as much effort as the other funds.
I would just add the other piece of that is that we've stayed clear of fund of funds because, in essence, we go to the fund of funds, obviously, to raise money for our clients, and to align ourselves with a specific fund of funds and raise money for somebody's competitor is probably problematic for us.
Okay. John asks, how should you think about LP mix over time, fund categories? For example, categories of limited partners in terms of how many endowments, pensions, etc.
I'll take a stab at that. This is Peggy. And one point I didn't make earlier, so I'm glad that this question is being asked, is with every strategy, there's going to be an initial resonance with a certain type of investor. If it's family offices, which it is in many cases, a lot of them tend to, if they find a manager they like, they will refer you to them. And a lot of funds will come to us for Fund 2 where they know that their source of capital is more focused with maybe one or two organizations and they want to diversify. And I think the question is smart in the sense that you never want to be reliant on one or two capital sources. You want to diversify it. However, when you move out of the family office space where larger organizations may not require the same level of data or all the boxes being ticked in the same way that an endowment or a foundation or a state pension fund might need to have those boxes ticked, you could be more limited until you're of a size and have the ability to provide the level of data and the response to due diligence questions that some of these other organizations are going to ask. It certainly does not hurt, as I said, to start a conversation with some of these other groups. Just be mindful that they may not be investors in your current fund. But, fundraising, as Jane said, is a long-term proposition, and you always need to be looking beyond your current fundraise to, the ideal place is, basically never having to use a placement agent again, because you've got the ideal mix of people who truly understand what you're doing and that they will always re-up and don't want you to bring any other investors in because they're fully capable of funding whatever you need to do.
Got a lot more questions coming in. Joe, who I think is in Boston, asks any rough guideline regarding debt versus equity, the debt versus equity mix for investment targets on the raise.
I don't understand the question, sorry.
Yeah, I don't either.
Understand it.
Yeah, I'm just, let's see, any rough guideline regarding debt versus equity mix. Okay, Joe, if you want to elaborate, just text me.
Usually the funds are either one or the other. We don't, I can say that we've been working mostly on the on credit because people have been looking for that in the past couple of years, moreover than some of the equity. But I'm sorry, I'm not clear on the question.
Okay, we'll have him clarify it. Randy asks, what is the best way for a hedge fund under 50 million in AUM to get in front of seeders? Seed capital.
I think it's pretty easy to find a list of the people who've done seeding. A lot of people have gotten out of that business, but there are some organizations, you just need to Google it and you call them. This is their business. They'll look at it. You have to be prepared to potentially give up an ownership position in the company. They'll probably give you runway capital. They may also invest in your fund at a discounted rate. But I think it's pretty easy to find the seeders out there.
Okay, you just mentioned.
And I'll add one thing on that. Just make sure that when you're going with a seeder that they will, hopefully add value in terms of making introductions for you for other investors. Because what happens is once you have a seeder, you've already kind of given up a lot of the carry in your fund and or fees, and that makes it difficult for you to hire then someone to help you raise capital because it leaves you with with less to give out, and you want to make sure you have enough to run your operations and that your staff is incentivized. So we found people who maybe have, they're looking at going to the seeder, but that seeder is just not going to help them any, further than really making that initial investment. And they do provide a good name, but then these people are left without any idea of how to raise the remaining money that they need.
Okay, you've mentioned runway money a couple of times. Michael's got a question. First of all, what does the term mean? And secondly, why do investors think it is important?
This is Peggy. I'll take a stab at that. Runway money is important because, as I mentioned before, investors want to know that they're not taking on a tremendous amount of organizational risk. So there are certain organizations, and they're not seeders, that will come in and commit to providing runway money, potentially money in the fund, to fund the organization for probably a 2-year period would be kind of a minimum, so that people know that even if the fundraising takes a bit longer than you anticipate, which in many cases it does, and we're always advising that you want to prepare for the worst, that there's money there and you're not going to fold up and walk away from the opportunity. So they want the managers of particular strategy to really be focused on executing the strategy and not worried about keeping the lights on.
Yeah, and that's why the first close is really important, at least on a private equity fund. And they want to, most people will, unfortunately, investors will want to see that a first close is completed before they even entertain a call or entertain due diligence, because it takes so much time and effort on their part to go through the diligence process. And if there's any risk, that this fund is not going to be able to close more than what they have already done, or if they're not going to be able to survive, then they just can't take that risk on, and they just aren't. And it's almost like herding cats, through this fundraising process. Everyone wants to know who's in the first close, and so yeah, so the runway money is important.
Okay. Jeffrey asks if Navatar's virtual data room is also built on Salesforce and whether it can be purchased as a standalone. Do you only serve hedge funds and private equity firms? So I'll answer that. The data room is actually built on Box because it's involving document management, but it is integrated with the platform that we use that's built on top of Salesforce, and Navatar is an overall financial platform, connected growth wealth platform. So it does have wealth management, mergers and acquisitions, mutual funds, placement agent, obviously, like Leora, private equity, PERE, and other capital market solutions, including fund of funds. Okay, Lawrence has a question. Hi, all. Great webinar. Thank you for inviting me. Have you done any fundraising for any single country long-only equity funds? As a Vietnam fund manager, we often come up against resistance in the U.S. as being too niche, despite a great track record of more than 10 years. Who wants to take that?
Well, we have been working with one group out in Asia for quite some time. I wouldn't say they're a single country, but they are a greater China. They have a greater China focus to it. Yep, I've been to Vietnam, spent a lot of time there. It is a niche. They do have great returns, and in fact, I have some friends who are running some wonderful funds there. You know, it's just it's difficult right now to do those single country, and I think that even the Greater China Fund has really resonated better in Asia with, let's say, the private banks there. And that seems to be a better use of their time to get assets under management locally and within the private banking community there that really better understands the country and the risks. And then once you have, you know, a significant amount of capital there, then I would go, you know, you can go into the U.S. market, into Europe. But yeah, that's what I would have to say. I don't know if Peggy, you have anything else to add. But
yeah, the only thing that I would add, and we talked about this on the last webinar, is managers who are located out of the country are at a disadvantage with a lot of investors who want to see annual meetings. They want to psychologically have access to the managers whenever they want. And this client that we've worked with, we've counseled them for years to set up a U.S. office or at least do a U.S. annual meeting because they do have investors here. You know, many investors don't have the budget to be able to go abroad. Others do. But I 100% agree with Jackie that the country risk, the political risk right now in that part of the world, I think people just don't see that there's a reason for them to, you know, take a risk at this point, unfortunately.
And I guess one last thing we've noticed is that the fees that our group in Asia had been charging were really significantly higher than the fees that some of the large domestic managers in the U.S. were charging for similar strategies. Now, it doesn't mean that they're not performing better. It's just the fees were different, and so it made it more difficult for some of the investors here to kind of make that jump to, you know, pay a little more for that when they felt, hey, I can invest here already in the U.S. with a manager that, you know, is well known and has an office here, as Peggy said.
Okay, Ramiel, I hope I have the name correct, asks, what strategies do you currently see as highest in demand from institutional investors?
We've been seeing, you know, most investors that we've been working with recently have been interested in the non-correlated strategies, strategies that don't involve market beta. Some of the ones that we've been looking at have been producing some sort of a coupon. They're in the credit area. You know, buyout strategies are always appealing, as well as growth equity. I would say the venture funds are very hard to raise right now, as they are more correlated to the market. And then, as we said, with the coupon, some of the real estate strategies are also of interest to investors.
Let's see. What percentage of a fund is too high to go over? Should you prefer to trim back everyone or just go over the cap by a bit? I guess that's when you're overly successful in fundraising. There have been a few questions like that. We're running out of time, so I'm trying to get through as many as we can here.
Yeah, that's a high class problem.
Yeah, you should have in your documents kind of a minimum and a maximum. And what I think we would say is it's better to not over-raise. You know, get those people in line for your next fund or separate accounts. But as Jane said at the beginning, stick to what you say you're going to do. Just because people want to give you money, if there's a capacity issue with your strategy, it absolutely makes no sense for you to take on more capital. And I think investors want to align with people who really understand their strategy, and they're trying to raise optimal capital to optimize returns. So that's, as Jane said, it's a super high-class problem to have. We've seen with other managers, people will actually get into a queue to be able to come into the next fund, or some kind of hybrid thing that you might set up. But people want to know that you're going to raise the right amount of capital, that you can deploy it in the right period of time and start producing returns.
Yeah, and I would say, add to that, a lot of times it's around whatever you put on your cover, you can do maybe 10 to 15% more, and that you should cap it at that. You don't want to go much more over that.
Okay, James asks, after an initial meeting, how do you keep an investor engaged? What is appropriate contact for follow-up?
Yeah, good question. We're pretty aggressive on, we'd like to keep, we will be aggressive. We're always trying to push for the call, for the meeting. You have to keep in front of them. Hopefully you're providing additional information as you go through the fundraising process. Any new information, you want to send out, new investors coming in, new investments that they're making into the fund. You need to be the squeaky wheel. I mean, that's what you're really paying the placement agent to make sure too that you're the squeaky wheel to the right investor. You don't want to be stalking people who are just clearly not interested in that strategy.
So here's one question out of Africa. This is from Kobus. We have a sub-Sahara Africa public equity strategy as the follow-on from they're referring to the Vietnam question, the single country long-only fund. Should we not focus on contrarian investors? How do we find contrarian investors? Also value investors who would form the base for a fundraise.
There are several endowments and foundations and people, you can Google it, that have been pioneers in frontier investing. And there are a fair number of organizations who have invested in Africa. I think my suggestion would be to try to identify those investors to see, in many cases, even if they can't personally invest, they may be able to refer you to somebody else in their investor group, people that they know who might be interested. But there has been a lot of investment, as I think in the African continent in various types of strategy, probably for the last 7 or 8 years.
Yeah.
Okay.
And also, I think you can look at some of the maybe some of the investor conferences too, to find certain groups that are active in that space, and then start to contact them and network through that area.
Yeah, the key word would be frontier investing.
Okay. I think there's a follow-on question here from Daniela, who's curious about how you view Middle East-based investors if you reach out to them?
We would love to be more in contact with Middle East investors. To be honest with you, we'd love to. We just have some of the funds that we've been working on, because they've been smaller, it just hasn't made sense for us to be reaching out. We've stuck domestically to the investor base here. No, we'd love to. It tends to be and also we'd like to go further also into Europe, and there's some groups there. There's some more difficult regulations now on placement agents overseas in terms of registration. I don't think it applies really to the Middle East, but there are some Middle East investors that are based in London and other places like that. The ones that are based in the Middle East, we just haven't really been in contact as much, but we'd love to be.
All right, one last question. This is, and I'm not sure how to pronounce this name, ANH, asks, with a couple of minutes remaining, any commentary on venture capital fundraising?
Yeah, venture is probably the toughest right now. It's all about performance with venture capital. And again, just to go back to what I said at the beginning, it's branding and your reputation. The high-profile venture funds are able to raise money. New funds, very, very difficult to break in.
Okay, we are out of time now. I want to thank the Leora partners, Jackie Beckwith, Peggy Caldwell, and Jane Morris for today's presentation. Thanks to all of you for participating and for sending in so many questions. For those that we didn't get to, I'm going to share them with Jane, and she can follow up with you. If you'd like to know more about all of this, check the slide. If you're curious about Navatar's financial products, obviously we'd love to talk to you about our full suite of products, and my contact information is on the slide, but there's a typo there, so let me just correct it. It's Siegert, so no G, well, ASIEGERT at navatargroup.com. And my number is 212-863-9655, extension 7434. Jane at leorapartners.com. That's the address for Jane Morris. Again, thank you all very much.
Thank you.
Thank you.